Welcome to the Deep Dive. We dig into the sources you share, cutting through the noise to get you the insights you actually need.
And today we're looking at Indigo, specifically their recent financial results and what they're planning next.
Exactly. This is all based on their Q4 and full fiscal year 2025 earnings call, plus the documents they put out around May 21st, 2025.
So we've sifted through the reports, the presentations, the management chat.
Right. Our mission here is to basically unpack the key numbers, the strategies, the challenges they talked about. We want to pull out what really matters, without you having to decode all the corporate jargon.
Let's do it. Where should we start? The big numbers.
Yeah, let's start there. The full financial year, FY25, ending March 31st. What did the top line look like?
Okay, so total income for the year. It landed around 841 billion Indian rupees.
And the significance of that?
Well, it's an 18% jump from FY24. But the real headline, it's the first time ever they've crossed the $10 billion revenue mark.
$10 billion. Wow, that really puts their size in perspective.
It's a major milestone, definitely. Global scale.
Okay, and how did that revenue translate into profit for the whole year?
So the reported net profit was 72.6 billion rupees. Now, that includes a foreign exchange loss.
Right.
If you take that FX impact out, the profit was actually 88.7 billion rupees. And management pointed out that ex-FX, it's pretty similar to last year's profit.
So big revenue growth, profit holding steady once you account for currency. Suggest some operational stability there. But the numbers that really seem to pop were from the last quarter. Q4, right? Jan to March.
Absolutely. Q4 was, well, pretty remarkable. Total income hit 231 billion rupees.
Which is up how much?
Up nearly 25%, 24.8% to be exact, year over year for that quarter. Really strong growth.
And the profit for Q4?
Net profit was 30.7 billion rupees. And they were very clear on the call. This was their best Q4 performance ever.
Best ever Q4. And the margin?
Net margin really showed that strength, yeah. Came in at 13.8%. That's a decent jump from 10.6% in the same quarter last year.
Okay, what drove that margin improvement in Q4? Was it just higher fares?
It was mainly two things, according to them. One, better unit passenger revenue. So yes, making a bit more per passenger. And two, a helpful fuel price environment. Fuel was cheaper on average than the year before.
Makes sense. And strong performance usually means thinking about shareholders. Did they announce anything like a dividend?
They did, yeah. Based on the strong results and, their confidence looking ahead, they've recommended a final dividend of 10 rupees per share.
Which still needs shareholder approval, I guess.
Right, standard procedure, subject to approval at the AGM.
Okay. Beyond the numbers they generated themselves, there was also some external validation, wasn't there? A credit rating.
Yes, and this is actually quite significant. They got their first ever international investment grade credit rating from Moody's.
Investment grade, that's important.
It really is. It's not just a label. Moody's highlighted their financial strength, their good liquidity, solid capital structure. It basically backs up the disciplined financial story Indigo tells.
Okay, financial picture painted. Let's switch gears to what's driving it, the demand, the passengers. What was the pattern through FY25?
Management described it as kind of a year of two halves. The first half saw demand moderate a bit.
Why was that?
They pointed to things like the general elections happening in India, plus some pretty intense heat waves. But then the second half saw what they called a remarkable surge.
Okay. What fueled the surge?
Think festivals, the big wedding season, and especially the Mahakumbh event. That really drove traffic.
That Mahakumbh is huge, isn't it? That explains the strong Q4 push.
Exactly. The Q4 domestic traffic surge was largely down to that. And Indigo responded, tweaking the network, putting bigger planes on routes where they could gauge upgrades, they call it, and adding more flights to places like Prayagraj and nearby airports.
And you see that in the passenger numbers for the quarter.
Definitely. They carried around 32 million passengers just in Q4.
Which is up
20% compared to the same quarter last year. And interestingly, their international passenger growth in Q4 was even stronger, over 30% year over year.
Over 30% internationally in Q4 alone. That's moving. What about the full year total?
For the whole of FY25, they flew 118.6 million passengers.
Just let that sink in. 118.6 million.
Yeah, it works out to roughly 1 million passengers every 3 days. It's staggering. And that itself is over 11% growth compared to FY24.
Now, they talked about who these people are.
Yeah, they mentioned it's a real mix. Families, business travelers, lots of first-time flyers, Indians coming home. Shows the broad appeal, I guess.
Okay, scale like that needs a serious operation behind it. Let's talk fleet operations. They added a lot of planes last year.
They certainly did. On a net basis, 67 aircraft added across FY25. But here's a really interesting stat they shared. In the calendar year 2024, they took delivery of 58 planes just from Airbus.
Okay.
And they made a point of saying this was about 7% of Airbus's total commercial aircraft deliveries globally last year.
7%. Just the Indigo.
Yes. And they stated they were the single largest receiver of Airbus aircraft in the world in 2024.
That's huge. What does that signal?
It signals incredible scale, obviously, but also their long-term vision, given their massive order book and just their importance on the global aviation scene now. It also directly links to another recognition they got.
Which was?
They were awarded World's Youngest Aircraft Fleet 2025 by Che Aviation for airlines with over 100 aircraft.
And that's not the first time, is it?
Nope. Third year in a row. A young fleet means efficiency, lower maintenance costs generally.
Right. And speaking of efficiency, what about getting places on time, OTP?
They said they regained the top spot for on-time performance in the Indian domestic market from September 2024 onwards.
How'd they manage that?
Down to specific internal efforts, reviewing flight schedules, block times, improving procedures. They gave a lot of credit to their employees, talking about the power of we spirit.
And that spirit must have been tested. They faced some big operational hurdles, didn't they?
Oh, yeah. They navigated some significant challenges. There's the ongoing AOG aircraft on-ground situation with those engine issues affecting some planes.
Still ongoing.
Yes, though improving. We'll get to that. Then there was a massive terminal shift at Delhi Airport, moving from T2 to T1, and even external tech stuff like that CrowdStrike outage that hit many companies.
Managing all that while running. How many flights a day?
Over 2,200 daily departures. They peaked at 2,304 in Q4. Keeping that running smoothly through disruptions takes some serious coordination.
Okay, so fleet growing, operations getting sharper. Let's look at network strategy. Domestically, sounds like they're just packing it in denser.
Densifying is the term they used, yeah. It's not just adding new dots on the map, but thickening the lines between existing ones. They launched 3 new domestic destinations in FY25, added multiple new routes, and increased frequencies pretty much across the board.
How many routes now?
Operating from 13 bases in India, serving nearly 490 domestic routes.
And having that dense network helps when things go wrong, I suppose.
Exactly. They gave an example from May 2025. Operations were suspended for 8 days at 11 airports in northern India.
Right, I remember that.
That meant about 170 daily cancellations for them. But even with that hit, they still operated over 2,050 flights a day across the rest of the network. And domestic load factors held up around 83%. It really shows the resilience you get from that kind of scale.
So domestic is about depth, but the big strategic push seems to be international.
Absolutely. This is clearly a major focus area. In FY25 alone, 7 new international destinations added, mostly in Asia.
And the growth rate there has been quick.
Remarkable, really. They said just 3 years ago they flew to about 25 international cities. By the end of FY25, that was up to 40. And they just added Fujairah, making it 41.
So almost doubled in 3 years.
Close to it, yeah. About a 65% increase in destinations in under 3 years. It's aggressive.
Where are they pushing geographically?
Kind of all directions. Better links to North and Central Asia. Westward, they mentioned Nairobi. Eastward, places like Indonesia. Management kept hammering the point that India is super underserved internationally, especially on longer routes where Indian carriers have traditionally had low market share.
They see a gap to fill.
A big one. And they've put a number on it.
In terms of capacity?
Yeah, ASKs, available seat kilometers. International routes accounted for about 30% of their total ASKs in FY25, their target. Get that over 40% by the end of FY2030.
Okay, over 40% international capacity. That leads us straight into the other big news, wide-body planes, a proper long-haul flying.
This is probably the headline grabber from the call, yeah. They've signed a deal to damp lease 6 Boeing 787 Dreamliners from Norse Atlantic Airways.
Okay, damp lease. Just remind us what that means.
Right. So basically, Indigo gets the aircraft and the flight crew, pilots from Norse. Indigo provides its own cabin crew and handles the operational side, insurance, maintenance under their control.
So it's a way to get wide-body capacity quickly.
Exactly. Faster than buying or dry leasing, which is just the plane, and building up all the pilot training and type ratings from scratch. It's a smart way to dip their toes into the wide-body water.
And they've already started using them.
The first one is flying, yes, on the Delhi-Bangkok route. They said initial customer feedback is positive.
And the other 5.
Expected in the second half of this current fiscal year, FY26.
And these planes let them launch routes they couldn't before.
Precisely. Starting this July, they're launching direct flights from Mumbai to Amsterdam and Manchester.
Europe direct from India on Indigo metal.
Well, leased metal.
Right. It's a huge step. Their first real crack at competing properly on these long-haul intercontinental routes. It lays the groundwork for their own future wide-body fleet. And they also mentioned their order for the Airbus XLR aircraft.
The extra long-range narrow body.
Yeah, and they specifically said those will have a dual-class configuration, so hinting at a more premium offering for longer flights down the line. Speaking of products, they're not just expanding the network, they're adding new things for passengers too. The Stretch product.
Yeah, Stretch. You can think of it as like a premium economy light, more legroom, some service extras.
Where is that available?
Currently on 5 domestic routes, they've got 16 planes fitted out, and it's also on that new Delhi-Bangkok 787 flight. Plan is to roll it out more as they get more configured aircraft.
How's it selling? Are people paying for the upgrade?
They said it's still, very early days, especially on routes where maybe only 1 or 2 flights a day have the stretch seats, like Delhi-Chennai. So no hard load factor numbers yet. But they seem optimistic it'll pick up as it becomes more common on routes, especially for business travelers who might value the space but book based on schedule first.
Makes sense. And they also launched a loyalty program, didn't they?
They did. Blue Chip launched about 7 months back.
How's the uptake?
Pretty impressive numbers already. Around 2.9 to 3 million members signed up.
That quickly.
Yeah, and they're partnering with big brands, Accor Hotels, Swiggy for food delivery in India. The idea is clearly to, build engagement, get people loyal beyond just the flight itself, and importantly, open up new revenue streams from these partnerships.
Right. Okay, so lots of internal moves, but they also highlighted some big external things happening in Indian aviation this year, where Indigo is playing a part.
Yeah, a couple of key things. First, the IATA AGM, the big global airline meeting, is coming back to India next week.
Hosted by Indigo.
Hosted by Indigo, yeah. It hasn't been held in India for 42 years, so it's a massive showcase for India and for India's aviation sector right now. Puts them center stage globally.
And infrastructure is changing too. New airports.
Definitely. Both Delhi and Mumbai are expecting their second airports to start operations sometime this year, and Indigo's committed to flying from both. In fact, they got to do the very first test flights at both new airports. A bit of a symbolic nod to their scale, I suppose.
And management sort of tied all this together into a bigger picture, didn't they?
They did. They explicitly framed all these initiatives, the growth, international push, new products, being involved in these big events as part of one strategy. And that strategy has 2 linked goals. Make Indigo a global aviation player, and help India achieve its own vision of becoming a global aviation hub.
So they see their success and India's aviation potential as connected.
Mutually reinforcing, yeah. It's a pretty powerful narrative.
Okay, powerful vision. Let's get back into the financial weeds a bit. The CFO discussion on costs and margins.
Right. So the CFO reinforced the strong FY25 and that record Q4 profit. They reiterated the Q4 margin boost came from, 1, better unit passenger revenue, and 2, the lower fuel prices.
Any specifics on the revenue side?
Yeah. Yield, the average fare per kilometer was up 2%, and the load factor, how full the planes were, was a very healthy 87.4% in Q4. That's up 1.1 points from last year. They chalked that up mainly to the Mahakumbh traffic and the wedding season demand.
And the cost side. Fuel obviously helped.
It did. FuelCat's cost per available seat kilometer for fuel dropped 6.6% year over year in Q4, mainly just lower average fuel prices.
But costs excluding fuel didn't drop. They went up a bit.
That's correct. CSK x fuel, X4X. So taking out fuel and currency effects, that actually went up 2.8% year over year in Q4.
Why was that?
A few things. Normal annual cost increases, like for maintenance contracts, airport fees. Also, the weaker rupee made dollar costs higher, and costs associated with returning older planes off lease, sending them through maintenance checks and MROs, that's necessary, but adds cost.
But it wasn't a huge jump.
No, and they said it was partly offset because they had fewer planes grounded compared to the peak AOG period last year.
Right. So even as they grow, keeping that cost base low is still job number 1.
Absolutely. Cost leadership is baked into their DNA. Management said they're actively working on finding synergies to keep costs range-bound for this year, FY26.
Range-bound, meaning flat.
Pretty much. They're aiming to hold overall cost levels similar to FY25. The plan is to use savings from reducing the damp leases as their own AOG planes come back and new ones arrive to offset cost pressures elsewhere.
Okay, speaking of AOG, what was the latest update on how many planes are grounded with those engine issues?
They gave a clear progression. It peaked back in Q2 of FY25, around the mid-70s aircraft grounded. That dropped to the 60s in Q3, then the 50s in Q4. And currently, they said it's down in the 40s.
So a definite improvement trend.
Yes, and they credited their team's flexibility for still hitting their capacity targets despite those groundings.
And fewer groundings means they don't need as many of those leased-in planes.
Exactly. As their own planes return to service and new deliveries arrive from Airbus, they're starting to send back the damp-leased aircraft they brought in to cover the gap. They returned 8 in March, another 5 in April. They'll keep adjusting that based on need.
Okay. Shifting to the balance sheet, sounds like they're feeling pretty comfortable there.
Very much so. They described it as strong, built on, prudence, careful spending, a solid structure, and that Moody's investment grade rating we mentioned, that really confirms the financial health and gives them room to maneuver for their big plans.
Did their cash pile grow?
Significantly in Q4, yeah. Free cash ended the quarter at 331.5 billion rupees. That's up 42.5 billion just from the end of December.
Wow. What are they doing with all that cash?
Several things. They're buying some assets outright, like 8 ATR turboprops for regional routes. They're also looking at owning engines, which can save money long term. Big investments in training 4 new flight simulator centers. And major spending on digital tech to support their 2030 ambitions.
Digital tech-like.
Things like NDC new distribution capability for selling through different channels and a new advanced revenue management system, building the back end for a much bigger airline.
What about debt? People always look at airline debt.
Right. Their total debt figure, which includes the accounting value of their leases, was 668.1 billion rupees at March end. Their related right-to-use assets for those leases were valued at 491 billion.
And their general philosophy on using capital. Where does the money go?
They laid it out clearly. Keep a big chunk as a safety buffer, about 20–25% of annual revenue. Then invest in growth digital fleet assets like the ATRs, engines. They also mentioned potentially putting more equity into financing future wide-bodies from 2027, and of course, returning cash to shareholders via dividends.
Okay, looking ahead now, what did they guide for capacity growth this year, FY26?
For the full year, they're guiding early double digits growth compared to FY25.
And for the current quarter, Q1?
For Q1 FY26, so April to June, they expect capacity to be up by a mid-teens % compared to Q1 last year.
Okay, strong capacity growth planned.
Yeah.
But how's the revenue side holding up this quarter? Any wobbles?
They said April started off strong, but then around April 22nd, with the increase in geopolitical tensions, particularly in the Middle East, they saw an impact. More cancellations than usual, and booking trends slowed down.
So things definitely cooled off after those events.
Temporarily, it seems. They did add that things have stabilized more recently, and they're starting to see bookings pick up again. They sounded optimistic about June seeing a recovery, but it's clearly something they're watching very closely.
You mentioned the geopolitical impact. Let's dig into a couple of specific points from the analyst Q&A session. First, the Pakistan airspace restrictions. How much is that actually affecting them?
Yeah, they addressed that. They said out of their 131 destinations, only 2 routes have actually been suspended because of it. Almaty and Tashkent.
Okay, just 2.
Right. It affects about 19 routes overall, maybe 30 flights a day out of their total 2,200 plus Gurway. And for other flights, it adds maybe 20–30 minutes of flying time for the detour. Their point was, because their network is so big and diverse, the actual financial hit is relatively limited.
Okay. And the other hot topic was their partnership with Turkish Airlines, using those damp-leased planes and code shares. Any issues there?
They were very clear. Everything they're doing operates strictly within the existing air service agreement between India and Turkey, fully compliant. They emphasized it serves a lot of Indian travelers connecting over Istanbul.
But what about the future of that deal?
They stated firmly that renewing or changing bilateral agreements is purely a government decision. Indigo operates within whatever framework the government sets. They said they have backup plans if needed, but right now, the focus is just serving customers under the current rules. They didn't speculate beyond that.
Got it. They also explained their code share strategy a bit more, right?
Yes. Basically 2 types. 1, Foreign airlines put their code on Indigo domestic flights, so their international passengers can connect easily within India. They mentioned Virgin Atlantic, JAL, as examples.
Okay.
2, Indigo puts its 6E code on flights operated by partners internationally, like Turkish or Qantas, so Indigo customers can book journeys on those networks.
Is it a big revenue driver yet?
It's still single-digit percentage of revenue, they said, but it's growing and strategically useful. The accounting's simple. Indigo collects the full fare, then pays the partner for their leg of the journey.
Right. And finally, that question about doing long haul as a low-cost carrier. Traditionally, that's been tough. How did they frame their approach?
This was really interesting. They drew a clear line between operating on a low-cost basis versus offering a low-cost product.
Explain that difference.
Indigo's strength is its super efficient, low-cost operational structure. They're absolutely keeping that. But they're not just taking their basic domestic product and stretching it to Europe.
So the product changes for long haul.
Yes. For Europe, they're including meals, offering that stretch premium seating. And those future XLR planes will be dual class. So they're using their low-cost foundation to offer an affordable but appropriate service for the long-haul market.
Not just cheap seats, but value based on efficiency.
Exactly. They see it as evolving towards being a global aviation giant, adapting the product for the market, but always underpinned by that core cost advantage.
Okay, let's try and wrap this deep dive up then. What are the key takeaways?
Well, financially, Indigo had a really strong FY25. Hit that $10 billion revenue milestone, posted a record Q4 profit. Demand recovered well, especially domestically, and they managed operations effectively despite challenges like ARG.
It's strategically.
Huge push on fleet growth, youngest fleet award again. Domestically, they're densifying. Internationally, it's all about acceleration, adding destinations rapidly. And the big one, stepping into wide-body, long-haul operations, starting with those damp-leased 787s to Europe. Plus, they're layering on new products like Stretch, building the blue-chip loyalty base, and investing heavily in tech and infrastructure for the future, all while keeping a laser focus on costs and maintaining a strong balance sheet validated by that Moody's rating.
And returning cash to shareholders, too.
Right, the dividend highlights that. They did flag that recent geopolitical stuff caused a bit of a blip in Q1 bookings, but signs point to recovery. Shows they're not immune, but maybe resilient.
So what really stands out, tying it all together, is that dual ambition they talked about. Indigo wants to be a global aviation player and help make India a global aviation hub.
Yeah, those two goals feeding each other.
So here's something to think about. Does Indigo focusing so explicitly on enabling India's global connectivity give them a unique edge? Is being the backbone for India different from just building your own global network? What could this strategy mean for Indian aviation's place on the world stage in the coming years? Something to mull over.